Ready? We're going to get started here. I have just a few minutes after 1 o'clock on my computer. So welcome to Survival Guide, Managing Cash Flow for Your Business. My name is Jillian Fairley, and I am the General Manager at the Center for Business and Economic Development. Our organization provides coaching and advice to small businesses as well as financing. We are pleased to offer this webinar today and to help you and your business. Just want to go through some housekeeping items before we get started. This session is being recorded and will be shared with all registrants following the webinar. You will be muted for the duration of the session, but please use the chat feature if you have any questions, and that can be throughout the presentation. So prior to today, several of you shared questions during the registration process, and these have been provided to our experts today, and many of those questions have been incorporated into the presentation. However, there's always room for additional questions. So if you have a question, please use the chat function. You'll find the chat at the bottom of your screen. To ask a question in the chat, please address it to all panelists and participants so everyone can see the questions. And we'll address as many questions as we can throughout the presentation. It is now my pleasure to welcome our presenters today. Alessandro Lupo is an investment advisor with RBC Wealth Management, and Christine Caroline is an accountant and partner with Caroline and Ashkabar LLP. Both have been extremely busy helping their own clients during this pandemic, and we are grateful that they're able to spend some time with us today and share their expertise. Cash flow is often a struggle for many business owners, but particularly during these challenging and uncertain times. The session will help you learn how to better track and manage your cash flow, forecast outgoing, expected, and unexpected expenses, and manage your debt payments. So it's now my pleasure to hand it over to Alessandro and Christine. Welcome and thank you.
Thank you very, very much, Jillian, for the introduction. I'm just going to share my screen here with everybody. Okay, so I believe everybody can see the screen share, and sorry, it's on a second screen, so I'm just looking off to my left. But thanks again for having me, and thanks for the introduction, Jillian. I'm going to get started. Again, as you all know, the presentation is on cash flow for your business. And some more introductions. Jillian already did it for us, but I put it here anyway. So Alessandro, he'll speak a little bit about himself later on in the presentation. I'll start. But he's a personal financial planner, investment advisor with RBC Dominion Securities. And myself, I'm a partner at Caroline and Ashkabar LLP, and also a facilitator and session leader and teacher for Chartered Professional Accountants of Canada. So that is a little bit about our presenters today, myself and Alessandro. So I'll get jumping right into the focuses of the presentation today. So I'm going to address the real causes of cash flow problems in businesses. I've picked the top 6 that I see on a daily basis on a regular basis, how to manage the cash flow and some tips and tricks and how I walk my clients through this from a personal need and a business need. And then we're going to look at, once we've walked through that and understood exactly where the cash flow problems are in your business and how to manage that, we get you on a program that we can better handle the cash, and then what we're going to do with that excess cash once we have a better handle on it of the business. So I'm going to jump right into the top 6 causes that I see that cause cash flow problems. So the number 1 problem I see is that business owners are excellent at what they do, at running the business and know their business inside and out, but they're not paying attention to the expenses. So they're doing well in day-to-day, excellent at executing the type of business that they're running, but not paying close enough attention to the numbers and the expenses. The second issue that I see is accounts receivable and collection issues. So this is sort of self-explanatory, but it's invoicing your clients and not following through or not able to collect on time, which causes shortfalls because you're outputting cash, paying your bills, but not getting paid from your customers on time. So it creates a lag and a discrepancy of your outflows and inflows. This causes some cash flow issues. The third point is bad or no bookkeeping. So I see this all too often is, again, I think this plays on to number one, but you're running your business, you're doing what you do best, and, bring in the box at the end of the year to your accountant and wonder why you have no cash in the company. So I can't stress this enough, is that you pay attention to your bookkeeping, to your expenses, and either do it monthly, quarterly, find a good bookkeeper. There are lots of them around, and just understanding your numbers and revisiting that. So we're going to go through that in the presentation, the bookkeeping component of this. The fourth item is expensive debt or highly leveraged. So this is where, we've bought a lot of capital assets, or we've bought a lot of things. We're in the startup mode. We're highly leveraged. We're paying high interest rates. Sometimes we're just paying interest on loans. So this can get quite expensive, and not knowing the cash flow, not knowing your inflows versus your outflows. This debt piece can be quite an issue and become quite a problem. So managing that is definitely something that clients should be looking at, and managers of business owners, I guess, should be focusing on. The fifth item is no cash reserve. So what happens when you've paid your bills, but you don't have that inflow from your receivables, and you don't have a line of credit, or you don't have personal money that can fund operations ongoing. So not having that reserve, not having that ability to pay your bills. And then expansion too quickly. Again, I see this, people start companies, everything is going great. Business is great, but then they expand too quickly, and we just don't have the leverage there to help them. Banks, Alessandra will speak to this, but generally need a year, at least a year, generally want 2 years of financials. So getting that lending can be quite difficult. So just monitoring your expansion, your cash flow, and doing your projections right is definitely some areas to focus on. And these are the problems that I see that cause cash flow issues. So the best practices, I developed this into 3 steps of how to manage cash flow. So this is something that I practice regularly, my clients practice regularly, and I'm going to walk you through an example in the presentation of exactly how this happens. So best way to manage the cash flow. First step is understanding, I'm sorry, I'm looking down, it's on the side screen, but clearly understanding your business income statement and balance sheet. Some people don't want to deal with their finances, but it is really, really, really important that you fully understand what they're telling you, because they are telling you a story. And we're going to look at one of those stories in a bit. The second point is taking a look at your financial personal situation to determine what you need for personal expenses. So on this, I think it's become clearer as we go through the example I've created for this presentation, but you just need to know exactly what you need to live. Some people are just pulling money out of the corporation or out of their business account if they're sole proprietors, and aren't understanding. They see that there's 10,000 in the account, and they pull it out because it's there and it's available and they need it to live. But taking that approach can lead to issues down the road. So really nailing this down is definitely very important for you and able to manage your cash flow. And then the third point is determining the best combination of the two between your business and what you need personally, and devising a plan and sticking to it. So this is going to be something that you and your advisor and your accountant develop, and you morph, and it should be an ongoing discussion. You say to your accountant or advisor, okay, I need more money, this didn't work. And then you have to develop a plan and stick to it. And there's lots of variables that come into this discussion, and we're going to look at those. But revisiting this at the beginning of your business and launching your company, maybe you're going to look at it more regularly. But as you get on a plan and once you're comfortable with how this works, revisiting it annually is what I recommend to clients. So your financial plan and then meeting with your accountant and looking at this. So let's go into an example about these 3 steps. So here is company ABC. So this is just a general company. I made up the numbers so that it flows. It's something that typically I would see. So we have income here of 500,000. Then we have our various expenses leading us to net income of 167,500. Factoring in income tax, the corporate tax rate, I use this in this instance. So this example is a corporation. Sole proprietors are slightly different because it's all on personal tax rates, but I've used this just for example purposes. So at the end of the year, after you've paid your taxes, you're left with $147,065. So we take a look at this and clients come to me and say, I had a great year. I made all this money. Everything looks great. So from the outside of looking at this, I think most people would agree. Company did great. But then because we're focusing on cash flow, I'm going to jump to the balance sheet. So it's important that we understand this income statement and what this is telling us. Yes, we had a good year. We paid taxes. But when I jump to the balance sheet, went too fast, of the same company, let's have a look here. So we have the assets of the company. We have accounts receivable. I'm going to talk about these issues. I've highlighted them. Accounts receivable, 70,000. This is money you haven't received. We have prepaid expenses, capital assets. It's a startup, heavily invested into some capital assets. So this is what you own at the end of the year. This is what your company has in assets. Then we look at the liability side. So you owe $9,900 on your line of credit. You owe people, some suppliers, $10,000. Your HST payable at the end of the year. This is a big one that people forget, that HST is due. Yes, it's cash you've collected, but it's cash you have to just turn around and pay the government. So figuring out what works for you, whether you put that money in a separate account, HST account, whether you prepay the installments to CRA for that HST, that is something that you need to figure out for your company, what works best for you in setting this $25,000 aside for HST payable come the end of the year. Then we have this income tax payable that we talked about on the last page. This is at the end of the year. You see your accountant, they say, okay, you had a great year. You owe $20,435 in taxes payable. Then we have this bank loan because we needed it to purchase these assets. And the shareholder of the company also loaned the company some money. So we have a lot of liabilities here that the company needs to pay, and we don't have any cash. So the issues when I look at this with clients, I say, your accounts receivable, it's high. And back to the pitfalls, we talk about, how can we manage this better? How can we get our collections and our AR turnover, in a better state, that I don't have $70,000 out there that is mine. I've done the work. Everything's, kosher. That should be my money. So collections is key and figuring that out. Capital assets is high. And so this is somewhere that I visit a lot with clients. Like, did we need to spend $300,000 in the first year? And this goes back to that pitfall of expansion too quickly. Maybe we did, that's fine. And, but, figuring that out with clients, also looking at lease versus buy options do impact cash flow. Also lending with the bank. Sometimes I talk to clients, lease versus buy. If the bank's going to look at your balance sheet and you've bought something, you likely have debt here. It's not going to help you out with your ratios. So sometimes we can play with that lease versus buy scenario, depending on where you're at in the business and what our goals are. So, and then we look here, we have the line of credit. Is the line of credit only 10,000? Are we almost maxed out? How are we going to pay these 10,000 in bills? So Then we have this HST of 25,000. I don't have any cash. I might be maxed out on my line of credit. How am I going to pay this? Again, this income tax payable. This is due 3 months after your year end. And so again, there are issues here. We don't have any cash. We didn't manage this properly. So going back, I come in with the balance sheet. They say they had a great year. Yes, absolutely, they had a great year. Where we need to spend time and focus on is the cash flow management. And that is what the story, this balance sheet is telling me. So that goes back to me saying that you have to understand what these financials are telling you. And just ask the question to your advisor, your accountant, anyone, because they'd be happy to explain this to you, and taking the time at your year-end meeting with your accountant and fully understanding this will just set you in the right path. So I've also gone through the next slide. This is monthly cash flow. I'm not going to go through the numbers in complete detail, but you start with your 10,000 that you loaned the company day one. We worked through some inflows. I'll share some apps later of how you can do this, but then your net cash at the end of the month carries to the next month. And then you go through the same exercise. You're going to have your cash inflows here. You're going to have all your cash outflows. At the end of the month, you should have 14,281 of cash in your bank. And then again, the same exercise. You start March with that ending balance, same exercise. You go through the whole year. At the end of the year, here's this negative 9,900 that I have on my line of credit. So monitoring this on a monthly basis, very, very important. Again, if you do your own bookkeeping, monthly, quarterly at the very least, and monitoring this cash flow is definitely key. So this is the next step. So we've looked at our financials, we understand them, we've made a plan to how we're going to deal with our cash flow. Then I turn to the owners and I say, you know, what do you need for personal cash flow needs at the end of the year? Normally we sit down, we come up with a budget just like this, you know, a mortgage, you got your utilities, food, daycare, all this. So you say to me or your advisor, I need $7,320 per month. And then the next step with your advisor from a cash flow perspective and linking the two very closely is, you know, for corporations, we have options. We can take this by way of dividends. We can take this by way of salary. We can also take this, we're going to look at the dividend salary option in just a minute, but there also is the option of a shareholder loan. So be careful with this. This is drawing money out of your corporation and not declaring it on your personal income tax return. And the issue with this is it has to be repaid within 2 years, or there's imputed interest benefit on your personal tax return. So just be careful you're monitoring that. So I know some people do get behind in filing their taxes. So if you are borrowing from the company and haven't declared it personally, this can cause issues with CRA. So this is our last resort. Sole proprietors, you're taxed on the net income of your business earned in the year at marginal personal tax rates. So from a cash flow perspective for sole proprietors, most important to look at that cash flow chart I gave and do a monthly inflow versus outflow, setting aside your HST. And again, I can share some resources for that. So, so the next step is we've talked to the clients. They've told me they need 7,320 per month. And we talked to them. This company had, I think it was 147,000 left in it after taxes. So we talk, do we want to take out dividends, or do we want to take out dividends and salary, or do we want to take out a wage? So I know this looks like a lot of numbers, but I've tried to simplify it as quickly as I could, simplify it with the least amount of numbers as I could. So we're going to focus on these columns here. So if I take out 60,000 of dividends each, so that's husband and wife, so it's 120,000 a year. All dividends, so I would declare 60,000 on her, 60,000 on him or her partner. The corporation is going to pay 16,340 in taxes because dividends are not expenses to the company. They come out of your retained earnings. So just looking at that there. If I take out a wage, you have half of the wage as an expense to the corporation. So from a corporate standpoint, you're paying less tax. And if it's a full wage, the entire thing is an expense to the corporation. You're paying very little tax because I've brought your taxable income to a very low amount. So from the dividends, we'll just focus here. Dividends, okay, all dividends, I'm paying this in corporate tax to CRA. I'm paying this to John personally, and I'm paying 5,349 to Lisa personally. So total tax paid combined between corporation and the personal taxes, $30,574. If I do a split, which is 30,000 in wage, 30,000 in dividends to each spouse, I'm paying 8,544 corporate tax. Here's my personal tax obligation to John. Here's my personal tax obligation to Lisa. Total tax, 27,765. So the difference between 1 and 2, looking at this just from strictly this point of view, I would save $2,809 by doing this dividend wage split. If I went to a complete wage, 60,000 salary to John, 60,000 to Lisa, I'm paying $872 corporate tax. Here's my personal tax obligation to John. Here's my personal tax obligation to Lisa. Total tax, $26,024. Tax savings from scenario 1, dividend, to scenario 3 is $4,550. But there are more variables we need to look at. So what is the cost to the company? The cost to the company in strictly dividends is $120,000. You've just taken out the 60 each. The cost to the company through the wage split is $122,000 because we have to remit the CPP on the employer side of the wages. And again, if I'm doing a full wage to John and Lisa, I'm paying the cost to ABC company is $125,000. So the CPP cost on those wages, $5,796. So here my cost is $120,000. Here I'm saving a little bit of, I'm saving $26.50 by doing a wage split. But if I went to a full wage from a cash flow perspective, I'm losing $1,246 every year. So that is where I talk to clients and we get the advisor involved and say, you know, how do you feel about CPP? Do we want to spend this extra amount of money every year in order for you to get CPP? Or does it make more sense to leave the money in your company and invest it there? So that is a discussion we have, and you need to think about in how you're going to pull the money out of the company. And then we look at, okay, so this is the last variable of how we're going to get this money out in order for you to live your personal life comfortably. So we've said we need this personally. We need $7,320 a month. That's my expenses. That's what I need to live on. That's a pretty tight budget. If I take dividends out, I'm left with $8,814 after taxes of money in my pocket. If I do the split, I'm left with $8,166. And this amount left over here is just what I'm left with after I paid my personal tax, less my expenses, my monthly expenses. I'm going to have an overflow of $1,494 if I go the dividend route. If I do the split route, because my taxes are higher and I'm taking out a salary, I'm only left with $846 after I've paid my expenses. And if I take out a salary, I'm only left with $101 a month. So this is where, again, we think okay, if I'm only left with $101, something goes wrong with my budget. I don't have enough money through the salary route to pay for anything that comes up unexpectedly. So we may choose the split route because, as we saw in the last slide, you were saving yourself about $26.50 by doing that from corporate tax and personal tax standpoint. And I have a bit of a buffer, and this is monthly. So over the year, extrapolate that. You're left with a pretty good buffer if something comes up. Or do we do the strict dividend route, which is the way I do tend to push people? I'm left with $1,494 every month left over, and this is where I push them to invest that. I mean, you haven't spent any extra money by taking out the salary versus dividend, and you have this extra money left over in your pocket because of the tax rates and the marginal tax rates and the way dividends are taxed. So this is where you would take this extra money or whatever you have left over and you go invest that personally. So things to think about of how you're going to withdraw money out of the company: dividends, split, salary. All of this has to be done after you fully understand how the business has performed and what your personal tax needs are, your personal expenses needs are. So to cap off, because there's not a lot of time, I just wanted to run through that scenario. I think it's better to see a practical example. And then some of the reminders are that I wanted to point out is, again, pitfalls that I see. HST is not your money. So just be very, very, very careful that you're setting that aside. The CEBA loan repayments, I mean, a lot of people have qualified for that. And then there's that extra distribution that's coming down fairly soon. We're getting more details on it daily. So planning for that now. Yes, you have an injection into your company of whether it's 40, 50, or 60,000. You have to plan for that now in order to pay that back to qualify for the relief. And setting that up properly is definitely key to do now. And then excess cash left in your corporation. So a big use, and from my standpoint, I mean, there are legal benefits as well, but for the corporation is the tax deferral. So I try and work very, very hard with my clients to formulate that personal budget, take out only what you need, and you leave the rest in the company to defer the taxes, invest it within the company, and then we use that as sort of your RRSP down the road. That's how we're going to pay you out at lower tax rates. So figuring that sweet spot out of what you need and what we can leave in the company, getting your cash flow under wraps is something that definitely needs to be, again, I can't stress this enough, monitored regularly and revisited regularly with your advisor and your accountant. And then I have this link here that we'll share with you, but I wanted to show you. I think you can still see. Alessandro, can you nod if you can see this RBC tool? Yeah. Okay. So this link here takes you to this cash flow tool. It will walk you through. Every bank has a tool like this. I'm just using RBC because Alessandro works for RBC and they partnered on this presentation, but every bank has this tool. You can go in 1 year or more, how long you've been in business, your money in. I want to calculate, and you can add all your money in. And it will prepare that cash flow for you. And it's just a tool that I think is available that should be used if you're not doing anything. And just working through this, you can go to your money out. You want to calculate it. You can put in all your expenses, and just helps you monitor your cash flow, and it will produce a report for you at the end, let you know what you're left with, so that you can use this for planning purposes. Develop a projection and then compare it monthly or quarterly. That would be something that I would think would be very beneficial to anybody. So I wanted to show that. I will share the link after the presentation. And with that, I think that's all I wanted to show was a real life situation. So I'll pass it over to Alessandro now.
Hello, everyone. Yes, I'm Alessandro Lupo. I'm with RBC Dominion Securities. I'm an investment advisor. I've been there for about 7 years, and before was at the retail side. So a couple comments once I'm able to take control. Here we go. So I primarily work with business owners, agricultural business owners, and retirees. There's a close correlation between both sides, as Christine's alluded to. And so when I first sit down with a business owner, I usually bring this, and I'll have a bunch of PDFs and some links that I will give Jillian to hand out later via email. But when sitting with my business owners, usually I bring this to the table because they actually will have encountered one of these questions, if not all, by the time at the end of their career. And so today we're short timed. I've got about 10 minutes, but the major one is, what should I do with surplus cash flow, or a deficit, of course, and how can I build employee loyalty? How will I manage risk? I'm going to touch upon a few of these and give you some insight as to what I see from when I sit down with clients, which is obviously a little bit different than what Christine sees on the other side. So the best piece of advice I can say is, when you find a banking advisor, and one of the pitfalls that I see coming from the retail side was transition of banking advisors and trying to find someone that will answer emails very quickly and efficiently. And the big difference between branch and RBC Dominion Securities, or any wealth management chain, so what I'm referring to is Scotia McLeod's, TD Waterhouse, CIBC Wood Gundy, RBC DS, we're the link to the branch, and a lot of people will fight to get up to us to work with us because we have a direct connection with the branch and have a tendency to spoon feed and follow through with what we deliver, versus just having a singular relationship at the branch with a local banking advisor, because they move on so quickly within 1 to 3 years, which I can't see anybody nodding, but usually that's the comments that I receive. So when I sit down with my clients, I do the financial plan, and I'm going to flip over here to the next page, and we put our clients in the center. So what does a comprehensive wealth management strategy include? Well, it includes all of these. I can't go through all of them today, but what I will go through is the credit and lending and the investing side. And some pertinent questions to ask your advisor or somebody that you can find that will assist you is, even though I'm primarily focused on the investing side, I have credit and lending background, which comes as a free advice piece. So I'm going to address the credit and lending side, and then work over to the investing side in a couple last questions. So, for the credit and lending, this is a resource and knowledge-based piece. So the first question I receive usually is, what are my options for emergency funds or financial planning? And me focusing on the financial planning side, there are 2 different types of setting an emergency fund for you on the personal side and the business side. And so what is that emergency fund? How much is it? How much should I have in savings? That is one of the major questions I always receive. But being a new business, sometimes having a positive cash flow of emergency fund is not possible. So how do we set that up? Well, it could be a line of credit, as an example. And so knowing your products and structuring them correctly is I'm a big advocate on, because I see when I sit down with a business owner and I'm assisting them, whether they're in positive or negative cash flow, when I look to see where their money's positioned, and I see a credit card, and I'll go through some of the rates, and I might be reiterating myself here if you don't already know this, but credit cards have interest rates of, let's say, 9.99% all the way up to 19.99%. So in a negative cash flow position, I'll sometimes see a contingency emergency line of credit that's sitting there empty, and they've been carrying a credit card balance for 3 or 5 months. Well, does that make sense? So understanding your knowledge base on the products from the branch, or even reaching out and asking the simple question, how can I enhance this? I've noticed that somebody will be carrying that credit card balance, and I'll tell them, pay it off with a line of credit, and then pay that line of credit down quickly. But what you don't realize, or maybe do not know, is that lines of credit are paid interest daily. So your timing becomes an issue, right? So what we try to do is teach people timing of the credit products and how to utilize them. Banks also have an additional once a month or once a quarter promotion for moving money from opening a new line of credit. So if you have access to that emergency line, what you can do is flip balances over and work with yourself, saving yourself a ton of money just given interest rates, okay? On the investing side, again, this comes to my specialty. And so once you find yourself in a positive cash flow, and I'm hoping several of you are, the nice thing to see, or when I get a call is, I have $100,000, I have $50,000 sitting in a checking account, and I'll ask time frame. And one of the most important pieces once you get into cash flow management is knowing one's time frame. And if you speak to any advisor, and there's a short time frame of less than a year for the money, take no advice on putting it into any market solution, so a stock or an equity. I will not do that. I'm a big advocate of finding out that time frame and making sure that you maximize interest on that money that you can utilize. And so from a product standpoint, we have our cash accounts, and interest rates have come down drastically low since the pandemic started. Our cash account rate used to be at 1.25. Well, in a matter of 2 days, it dropped to 0.20. So we're seeing that on short-term cash flow solutions. GICs, typically you can get a 30 or 60-day GIC, and that relates to less than 1% as well. And then you're getting into the bond markets. And so I have a strategy that I put in place for business owners that I will roll GICs or secondary GICs to maximize interest, meeting a time frame of, let's say, a business project that might be six months down the road. So I can't stress enough to utilize and know your products. And one of the other things I always say is, how much time do you spend on your hair or getting dressed in the morning? If you're spending 15, 20 minutes, a lot of people spend more on their cosmetics than they will on their finances, and it should be the other way around. One of the other big questions I get also is how to build resiliency in your business. And so another complaint I get for some of my big construction companies and other companies that deal with maybe minimum wage workers is how to obtain and keep those employees. And what every bank also has is a group savings or a group RRSP plan. And it's something that I recommend or will put my clients in front of, because it's a way that you can retain your employees. There's group RRSP plans for 0 to 5 employees, from 5 to 15, or 15 plus. And what that looks like is forcing your employees, not forcing, but agreeing with your employees to deposit a certain sum of money into an RRSP, building an asset down the road. And what I find is that a lot of employees will not save for retirement, and by adding that component to your business, it does show the professionalism and longevity of your company. And so if you can show an employee, in two years' time that they've saved $15,000, $20,000, you're adding value to their life. And then what RBC or what another bank will do is they'll build in a vesting option. So a vesting option is usually a 2-year time frame where the employee can't touch the money. And so therefore, if an employee is going to leave, they need to make the option or decision whether they want to leave behind $10,000 or $15,000 if it hasn't been invested, which the company will receive back. And so RBC has it for myself. All sorts of companies run these, and I can't stress enough to definitely take a look at this option for yourself. There's some numbers out there that effectively shows a retention rate of 70% or more on keeping your employees intact with your company, especially if you're putting all those resources and time and energy into training them. Okay. We have a question from Jillian previously, so I'll read the question and Christine and I can piggyback off it. What is the recommended ratio of gross income to be kept for reinvesting in the business, setting aside for emergencies, and finally for bringing home as a net salary? Is there a recommended formula, especially for businesses still growing and needing a lot of reinvestment? The answer comes down to, on my side of the fence, it's a personal budget, and Christine's touched upon that. So I will send Jillian as well an Excel spreadsheet that pretty much addresses all the expenses. And so what we do is we create that monthly or annual budget. And if you know that amount, what we can do is we can determine what one's income is needed. And from the last statement that Christine showed, that is huge. I find clients will take money from their corporation or request it for all sorts of various reasons, toys, family, tuition, and not knowing what exactly they need. But if we know what they need, then we can plan. And I guess the whole finale of this is, and my delivery is being proactive and not reactive. And I think that's been beat down in the industry a lot, but truly it's staying in communication with your accountant and your financial advisor planner, and making sure that the three of us, or the three individuals, discuss what the implications are of each and every one of your moves. So I tell my clients, even though I'm on the investing side, if they want to buy a vehicle, give me a call and let me know. I can strategize some numbers from leasing and from borrowing outright to paying cash. And in an interest rate environment like this right now, we've seen all-time lows. Right now, a lot of people are choosing to leverage versus taking money from their investments. So Christine, is there a part that you would like to add on to that question?
No, so you touched on a lot of it, but I guess there's no formula, and it's on an individual basis that we generally come up with a plan. But what I would say, as written in the response to this, is that, you know, as we've seen with COVID, and even prior to COVID, I would always say your fixed costs, make sure you have at least 3 months worth of fixed costs saved for any type of interruption. And I mean, COVID obviously shed light on a lot of that not a lot of people had that. And, you know, most people don't. And I'll admit that most people don't. But ideally, if we could get to that, that would be the ideal situation to be in, to have 3 to 6 months worth of your fixed costs saved.
Yes, I definitely.
And I think there were more questions that came in earlier that I don't know if, Jillian, do you want me to touch on them, or did you want me to read them? I wrote short notes, but I can go through them. Or do you want to read it?
No, it's okay. You go ahead. That'd be great. We have some other questions coming through as well, but why don't you start with the ones that were asked during registration, and then we'll jump to the chat.
Okay. So the one I have is, are there any apps for cash flow? I touched on that. We'll send out a link to everybody, but there are apps with every, I think that's what we're getting at, is every bank has links to these types of things. Also, there are templates on Excel that if you put in personal budget or budget template, like you'll find quite a few on there that you can work off of and tweak to be unique to yourself. So there are some out there. I will send the link out, or we'll have the link available to you somehow that I touched on. And then otherwise, I would just direct you towards Excel for that, for those, because there are plenty. Taxes low, how to keep your taxes low when withdrawing from your company. Again, I think this is where you have to really work with your accountant, look at the tax rates and try and keep you in a low tax bracket. I mean, there are various tax brackets, and there are federal tax brackets, there are provincial tax brackets, and we need to combine them, and we want to keep you low. I mean, I like to keep my clients in less than the 40% ideally, if we can. But if we can't, I want them less than the 50%, and it's keeping them there, using other ways to get them lower. You know, if they're taking out above the 35%, usually that's when I start talking about RSPs, because it's a direct correlation. If you're paying tax on your tax rate's 40%, then you contribute to your RSP, you're saving 40% on whatever your contribution is in personal taxes. So no real way to keep your taxes low. Again, if you need the money to live, and everyone needs money to live, we have to withdraw that so that you can live a comfortable life. But it's finding that sweet spot where you're in the lowest tax bracket we can get you in for your personal needs. So again, I would just say that you'd have to develop that budget personally, and then talk to your advisor on how to get the money out to you to live that budget, and any tax planning opportunities that would be available to you. And then key metrics, I think, was another question. I can try and address this one, but key metrics. So I'm trying to understand the question, and I think it goes back to the one that's on the screen. I think it's unique to every business what the metrics are. You might be in a business that, you know, doesn't generate a lot of cash flow on a monthly basis, and maybe you're doing fewer larger projects, so it might be different for you versus someone who's providing a service and there's lots of cash exchanging hands every day. So I think, again, that there's no key metrics that cover everything. I think it's unique to your business. And again, if you have any specific questions to your business and want to get a little bit more personal, I'm happy to answer them. I think Jillian can share, or I'll give her authorization to share my contact, and you can reach out to me. I'd be happy to answer any specific metrics to your particular industry.
There's another question here. From a personal perspective, your comparison of dividends split and salary seems to make dividends a clear choice of the corporation's owner. Why would a business opt to pay salaries? There's an accounting piece in there, and then also a financial planning piece. And the main difference between the two is one pays your CPP, so that's your Canada Pension Plan for down the road, and that's a decision that your accountant and you must have, but affects the financial planning side down the road. And so if you've been taking dividends, you're not paying CPP, you're not paying into CPP, and therefore won't be collecting down the road technically. And therefore, if you're paying yourself a salary and you want that, and you would like to collect CPP later on in life, so age 60 to 65, it's a whole different conversation to have. But what I see with most of my business owners is that, maximum CPP this year for a person who's 65 years of age is around $1,100. And so when you have a corporation or you've saved because you've been diligent, that cash flow and that CPP sometimes, especially for corporate owners, that CPP is insignificant. And so I usually am discounting a CPP down in my platform, in my financial planning software, from 100% down to 80%, build that buffer in there. And, if you're not anticipating that, once you build all your categories from RRSPs to tax-free savings accounts, adding in your non-reg corporation, or sorry, your non-reg accounts and your corporate accounts, if you wait until the age of 71, that can all creep up where your old age security gets completely wiped out. And that's a free $7,000. When I say free, we've all paid into it, but $7,000 each if you have a spouse, that can get wiped out above a certain threshold. So we try to plan for this. And as you can see, there's differences, but a lot of similarities between Christine and myself's business, where we need to be cognizant of what you're doing.
Mhm.
Great, thank you for addressing all the questions. Let us know if you have any other questions in the chat. For sure, it's still open. But one of the comments I also wanted to make, coming from a lending institution around taxes, going back to that question, was a lot of business owners that come to us applying for financing have really tried to minimize their taxes. Nobody wants to pay taxes. But if you're looking to borrow money, that's something to think about as well, and work with your financial planner and your accountant, because if there's nothing to show on the taxes that you've earned enough income to pay taxes, it's extremely difficult to borrow money. So that's something to think about as well. If you don't need to borrow money, then by all means, there's no reason to pay extra taxes when you don't need to. And you can maximize those expense deductions. But if you need to borrow money, then that's something to think about long term, is how you're showing that you're making enough money and paying taxes. So that's an important consideration as well.
Mhm.
Great. So I don't see any more questions in the chat. So I think we'll wrap up the session, but I wanted to say thank you to both Alessandro and Christine for an extremely informative session. I certainly encourage all of our clients and all small business owners to have advisors at their table, including individuals like yourself, because it's really important for that personal side and the business side, and they're so closely blended in the businesses that we operate in this community. So it's extremely important to have advisors helping you out. I always learn something extra by listening to experts, and certainly business owners will as well. So once again, thank you for the session today, and thank you for the participants who attended. A recording of the session will be available after the event, so we'll share a link to that recording. I know Christine and Alessandro also mentioned some really valuable tools and resources that we made available too. So we'll send out an email with attachments to tools that they've so kindly offered to share, as well as a short survey about the event. So if you have some feedback, we'd love to hear from you. So once again, thank you to our amazing presenters today. Thank you for attending. Wishing everyone a fantastic rest of the day and week, and take care and stay safe.